Germany is slowing down, and Poland is filling the gap. Europe's economic powerhouse just posted dismal growth forecasts despite pumping €1 trillion into stimulus spending. The Bundesbank admits Germany won't reach pre-recession levels until late 2026, 4 years of lost momentum. Meanwhile, industrial weight is quietly shifting eastward as supply chains reorganize and investment flows redirect. Most people never see this happening, but the data reveals a fundamental rebalancing of European economic power that could reshape the continent's future. Germany's economic engine is sputtering like a heavy truck stuck in mud. For decades, this industrial giant powered Europe forward with precision engineering and stable growth. But something fundamental is broken. The numbers tell a stark story. Despite that massive €1 trillion injection, growth projections keep getting slashed. The Bundesbank now forecasts just 0.6% growth for 2026. That's barely above stagnation. Federal debt is set to rise 50% over 5 years, climbing from €1.7 trillion at the end of 2024 to unprecedented levels. Think of it like pouring gasoline into a truck with clogged filters. The fuel goes in, but the engine can't process it efficiently. Demographics are shrinking the workforce. Energy costs remain crushing. Export markets are slipping away, with a 2.1% drop in 2024 alone, especially losses to China. But here's what's really unsettling. Germany's soft power ranking just dropped from 2nd to 4th globally. The Brand Finance Global Soft Power Index shows a 2.4-point decline, with the country's economy ranking specifically falling from 2nd to 6th. Cristobal Pola Vasquez from Brand Finance warns that perceptions are shifting, reflecting growing global uncertainty about Germany's economic trajectory. While Germany struggles with this industrial crisis, something else is happening across Europe's eastern border. Investment flows are quietly redirecting. Supply chains are reorganizing. The question isn't whether Germany can recover, but where exactly that economic weight is landing as Europe's center of gravity begins to shift. The European Union's own forecasts paint an equally troubling picture. Germany faces complete stagnation through 2025, with growth barely crawling to 1.2% by 2027. Government debt will surge to 67% of GDP within 2 years. These aren't temporary setbacks from external shocks. They're structural problems that massive spending can't solve. Anonymous analysts at the Bundesbank describe the situation in stark terms. Germany won't even claw its way back to pre-recession GDP levels until late 2026. 4 years of lost momentum from what was once Europe's most reliable engine. The fiscal multipliers that normally boost economies during downturns are hitting supply constraints that no amount of borrowed money can overcome. Here's the reality behind that €1 trillion stimulus package. It's going toward infrastructure and defense spending, but productivity gains remain virtually non-existent. The economy is like a patient on life support. The machines are working, pumping resources through the system, but the underlying vital signs show no improvement. Amundi research analysts capture the mood perfectly. Risks to growth remain skewed to the downside in the short term, they report. While they express cautious optimism about the medium term, recovery depends entirely on reforms accelerating at a pace Germany hasn't managed in decades. The psychological impact runs deeper than statistics. Germany built its post-war identity on economic stability and industrial strength. That foundation is cracking. Business confidence remains weak. Investment continues contracting. The country that once anchored European prosperity now radiates uncertainty across the continent. Trade tensions compound every problem. Export-dependent Germany faces mounting pressure from China, its largest trading partner, while struggling to maintain competitiveness in traditional manufacturing sectors. The old model of German engineering excellence commanding premium prices is breaking down as global supply chains prioritize cost and flexibility over prestige. This isn't just an economic crisis. It's an identity crisis for a nation that defined itself through industrial leadership. The deeper structural problems reveal why stimulus spending feels like pushing rope. Germany's demographic cliff means fewer workers supporting more retirees every year. The energy transition, while necessary, has created some of the world's highest industrial electricity costs. Bureaucratic layers slow decision-making precisely when agility matters most. Labor shortages affect every sector. Skilled trades, engineering, healthcare, logistics. Critical industries can't find enough qualified workers. Immigration helps, but integration takes time Germany doesn't have. Meanwhile, competing economies are building modern infrastructure while Germany maintains aging systems that worked brilliantly in the 20th century. The mechanical metaphor becomes clearer. Germany's economic engine isn't just stuck in mud, it's an older model trying to compete against newer designs built for different terrain. The trillion-euro tow rope might eventually pull it forward, but the fundamental question remains whether this heavy industrial truck can navigate tomorrow's economic landscape. Regional disparities worsen the challenge. Eastern German states still lag decades after reunification. Northern coastal regions struggle with maritime industry decline. Even Bavaria, Germany's wealthiest state, faces automotive industry transformation that threatens traditional employment patterns. What makes this particularly unsettling is how quietly the shift is happening. Most Europeans don't realize their continent's economic map is being redrawn in real time. Supply chains built over generations are relocating. Investment capital flows toward regions that seemed peripheral just years ago. Industrial capacity is moving eastward as companies seek lower costs, better logistics, and more flexible regulatory environments. The brand finance data confirms what many suspected, but few wanted to acknowledge. Global perceptions of German economic invincibility are evaporating. When international investors and businesses lose confidence in a country's trajectory, capital flows follow sentiment. Money seeks stability, growth potential, and competitive advantage. If Germany can't provide those fundamentals, other destinations will. Poland represents something Germany used to embody: rising industrial capacity, growing consumer markets, strategic geographic positioning, lower operational costs, younger demographics. Political stability focused on economic development rather than managing decline. This transition isn't happening through dramatic announcements or policy declarations. It's occurring through thousands of individual business decisions. A factory relocates production. A logistics company shifts its European hub. A technology firm chooses Warsaw over Munich for expansion. Each decision seems minor, but collectively they're reshaping European economic geography. The question facing policymakers isn't whether Germany will recover eventually. Most economists expect modest growth resuming by 2027 if reforms accelerate. The real question is whether 4 years of lost momentum, combined with ongoing structural challenges, have permanently altered Europe's economic balance. Some changes, once made, prove impossible to reverse. The shift is already visible to those who know where to look. While Germany wrestles with stagnation, Poland has quietly positioned itself as Europe's new industrial destination. Foreign direct investment flows tell the story. Manufacturing facilities that might have gone to traditional German industrial centers are instead choosing Polish locations. The math is compelling for businesses seeking competitive advantages. Poland offers what Germany increasingly struggles to provide. Younger workforce demographics mean abundant skilled labor, without the aging population pressures crushing German productivity. Energy costs remain significantly lower, especially for manufacturing-intensive industries. Regulatory frameworks designed for growth rather than managing established systems. Geographic positioning that optimizes access to both Western European markets and emerging Eastern European opportunities. The transformation isn't limited to heavy manufacturing. Technology companies, logistics operations, and service industries are discovering Poland's advantages. Warsaw's financial district rivals traditional European centers. Kraków attracts multinational corporations seeking cost-effective operations with European Union access. Gdansk has become a major logistics hub connecting Scandinavia, Germany, and Eastern Europe. Consider the automotive sector, Germany's industrial crown jewel. Major suppliers are establishing Polish operations not as subsidiary locations, but as primary European manufacturing bases. Battery production for electric vehicles, electronic components, precision manufacturing. Industries Germany dominated for decades are building their futures in Polish facilities. The labor dynamics reveal deeper structural advantages. Poland's education system produces engineers, technicians, and skilled workers at rates Germany can't match given demographic constraints. Universities collaborate directly with industry in ways that streamline workforce development. Young Polish professionals offer the same technical competence as their German counterparts, but with greater flexibility and lower operational costs. Infrastructure investments amplify these advantages. Poland has modernized transportation networks, digital connectivity, and industrial facilities using European Union development funds while Germany maintains aging systems. New Polish factories operate with cutting-edge automation and efficiency standards that older German facilities struggle to match without massive capital investments. The European Union's own development strategy inadvertently accelerates this transition. Cohesion funds designed to reduce regional disparities have created world-class infrastructure in Poland precisely as Germany faces infrastructure maintenance backlogs. EU policies promoting industrial diversification away from traditional centres align with business incentives seeking competitive locations. Banking and financial services reflect changing priorities. Polish institutions increasingly handle transactions and financing that might previously have flowed through German financial centres. Corporate headquarters relocations, while still limited, indicate long-term strategic thinking about European operations positioning. Supply chain reorganization proves particularly revealing. Companies serving multiple European markets can achieve better cost structures and delivery times from Polish locations than traditional German bases. The geographic center of European economic activity is literally shifting eastward as logistics optimize for modern distribution requirements. This rebalancing creates momentum that exceeds individual policy decisions. As more businesses establish Polish operations, supplier networks develop, talent concentrations grow, infrastructure investments accelerate, regional economic ecosystems strengthen in ways that make Poland increasingly attractive for additional investments. The timeline suggests this shift has years remaining before reaching equilibrium. Germany's structural challenges, demographics, energy costs, regulatory complexity won't resolve quickly, even with optimal policy responses. Poland's advantages in these same areas provide sustained competitive positioning that should continue attracting economic activity throughout the decade. However, Poland faces its own challenges managing rapid growth. Infrastructure strain, housing costs in major cities, and wage inflation could eventually reduce competitive advantages. The question becomes whether Poland can maintain its trajectory long enough to establish permanent industrial leadership in key sectors before cost pressures erode current benefits. Currency dynamics add another layer of complexity. The euro provides Germany stability, but limits monetary policy flexibility. Poland's zloty allows more responsive economic management, but creates exchange rate risks for international businesses. These financial factors influence long-term investment decisions in ways that could accelerate or moderate the industrial transition. What emerges isn't German collapse, but European rebalancing. Poland isn't replacing Germany entirely, but absorbing specific industrial segments where competitive advantages prove decisive. The continental economy is diversifying away from excessive dependence on any single national engine toward more distributed growth patterns. As of January 2026, this transition remains incomplete but accelerating. Germany's hoped-for recovery, beginning in 2027, might restore growth momentum, but 4 years of lost industrial investment have created competitive gaps that Poland continues filling. The European economic landscape is being redrawn through market forces that policy interventions can influence but not reverse. The implications extend beyond economics into geopolitics. European Union power dynamics shift as economic weight redistributes. NATO strategic planning must account for changing industrial capacity locations. Trade relationships with global partners adapt to new European production patterns. This isn't the story of one country's decline and another's rise. It's the story of continental economic evolution, adapting to changed circumstances through mechanisms most people never see. Industrial weight moves quietly, through business decisions made in corporate boardrooms rather than government announcements. Europe's economic center of gravity continues shifting eastward as businesses optimize for competitive advantage rather than historical precedent. Poland didn't plan to fill Germany's gap, but market forces created exactly that opportunity. The transition will likely continue until new equilibrium emerges between European industrial capacity, demographic realities, and competitive positioning. Whether this rebalancing strengthens or weakens European economic resilience remains the defining question. Geographic diversification reduces systemic risks from any single country's problem, but might sacrifice the concentrated industrial expertise that made Germany Europe's engine for decades. The world is watching this quiet revolution reshape Europe's economic geography. Subscribe to follow how this unprecedented transition unfolds and what it means for the future of European power. The next chapter of this story might be the most significant yet.